I'll go ahead and get us going. My name's Josh. I'm the owner of Breakthrough Real Estate, Property Management, and Handyman Services. Been a local realtor here for about 13 years now. Owned the brokerage for about 6, and then we've had our handyman company for about the last 3 years. And pretty much the reason we put on these classes is to offer value to the world, because in cases like this, a reverse mortgage for purchase can be used for your clients and for you, and you could actually let your office know that they exist, because there's a lot of good that these can do. A lot of people have archaic views of what reverse mortgages are, and I started this. I started wanting to put on this class about 3 years ago, because about 5 years ago, I saw one in action and it helped my clients significantly. I had clients that were aging, they owned about 2 acres in Surprise in a manufactured home, and it was a lot to maintain. He had a couple shops, blah, blah, blah. They wanted to sell that and move closer to town. Catch is, when you move closer to town, it's a little more pricey. And while they were still going to, get about I forget exactly what it was, about $140,000 or so, out of their home, how much cash was that going to allow them to purchase, right? And so we looked at everything in Surprise and El Mirage, and it wasn't going to get the job done for them. And fortunately at the time, I had a lender who's no longer in the business who said, "Hey, have you thought about doing one of these?" And I was like, "What? No, I'm looking out for my client's best interest. Of course I haven't thought about that." And he's like, no, wait. They can use their cash to buy their next home, and they could actually live there for free. And instead of buying a $120,000 home, they'll be able to buy a $240,000 home, $250,000 home, and be in a good neighborhood. And he swore, and I made him, and this was so funny. I wish I had a recording of that conversation. I made him swear up and down, backwards and forwards. So they're not going to get kicked out, right? No. And there's no hidden fees. Like, they're not going to have this balloon payment, and they're not going to get, the family's not going to get screwed. He's like, no. And we went ahead and they did it. And it allowed them the retirement that they deserved. They are closer to their kids. They're actually in West Point in Surprise, right there, right behind the intersection right there. Like, it is close to shopping. It was exactly where they wanted to be. So as of that moment, I became a huge fan of the reverse mortgage for purchases. So I'm so happy to have Kathleen and Scott here again to share. And what's great about a smaller class is that feel free to ask questions. Let's make this personal. If you know anybody, if you have any thoughts, please just chime in. Let's have a great conversation, because there's a lot of angles to this, and she has a lot of great information to share. So, Kathleen, I'll go ahead and hand it off to you.
All righty. Thank you for that story. That's such a classic story we hear all the time. And I hope that loan officer reached back out to your clients to let them know that the property values have gone up so much they can probably refinance their existing HECM and even get more equity out of their home, and have a larger line of credit to draw from. So I just want to welcome and thanks for joining us again. As Josh said, we're going to be discussing the benefits of the HECM loan, and HECM is actually let me share my screen. I'm sorry. Duh. Hold on. You have it? Is it up?
It's good in here.
Hello?
I think you have a slightly slow connection, unfortunately. There it goes.
Okay. Yeah, I'm dragging over here. I don't know why. I apologize. So we're going to talk about the basics of a HECM. And HECM is an acronym. It stands for Home Equity Conversion Mortgage. It's also known as a reverse mortgage. The HECM term is an FHA term because it's an FHA product for reverse mortgage. So before we get started into that, let me just tell you a little bit about Open Mortgage and Scott and myself. Open was founded in 2003 with only 3 employees, and we've grown to nearly 400 employees. With over $1.8 billion in loan volume in 2020, Open is the 6th largest privately owned reverse mortgage lender in the nation. So we're a multi-channel mortgage lender that services thousands of clients. We're licensed in 46 states and the District of Columbia. And at Open, we believe that better having to bring better mortgage experience to everyone. So Scott is our branch manager here in the Sun City West branch. He graduated from the University of Utah with a degree in marketing and management, and he has a long career in the mortgage industry. He's specialized in reverse mortgages since the mid-1990s, and he has originated thousands of HECM loans. As a matter of fact, it was during his tenure as president of Sun Valley Financial that Scott was involved with closing the very first HECM for purchase loan in January of 2009. So I'd say he's got quite a bit of experience. And then in 2012, Scott joined Open Mortgage as the branch manager here in Sun City West. He's licensed in Arizona, Washington, Idaho, and California. And it was early in Scott's career that he found that helping seniors obtain a reverse mortgage can be a life-changing event. And it was at that time that he became focused on the reverse mortgage programs and the many ways that it can help seniors in our community. My name's Kathleen Edger, and I'm a licensed mortgage loan officer specializing in reverse mortgages here at Open Mortgage. And I'm licensed in Arizona and Washington. I moved to Arizona after graduating college in Texas with a BBA in finance, and my career focus has been in the housing and mortgage industries. I spent 7 years as a mortgage loan officer building strong relationships with realtors. And it was a top realtor team that asked me to join their team back in 1989. And so I got licensed, and I spent over 30 years as a licensed sales agent and broker here in Arizona. I've recently returned to the mortgage industry. And like I said, this time I decided to dedicate myself to specialize in reverse mortgages. Scott, I've witnessed the life-changing impact the reverse mortgage can have on a retired citizen, and I think it's the most misunderstood product and underutilized loan program that's out there. As a real estate broker, I've seen how the HECM for Purchase program can benefit senior buyers and real estate agents alike. And as a result, it's become my mission to educate senior homeowners and their realtors how to utilize this program to achieve financial peace of mind and enjoyment in retirement. So let's talk about the HECM for purchase. In simplest terms, a HECM or reverse mortgage it's just a mortgage, but it's a mortgage without a payment. So the reverse mortgage is the only loan specifically created for folks in retirement, because you don't have to go through the same rigorous qualifying factors that you do with a traditional loan. So let's talk about more about what is a HECM. So a HECM is a home equity conversion mortgage, and it's federally insured, and it allows homeowners age 62 and older to convert a percentage of their equity in their house into a line of credit or to purchase a home. Now, on the purchase, the approved amount is applied to the sales price of the home. Okay, so the HECM loan began in 1989. It's a non-recourse loan. The borrower is not responsible for any deficiencies. The HECM for Purchase program was created in 2009 by the FHA, and it lets seniors and age 62 and older purchase a home with about 40 to 53% down payment. I'm sorry, I've got a little gnat bothering me. And have no mortgage payments. You still have to pay your taxes and your insurance. And if there's an HOA that applies, you have to pay your HOA fees and keep the property maintained. But you do not have to pay a mortgage payment. Now, we hear a lot about, a lot of people, when I first mentioned the reverse mortgage or a HECM mortgage, they get a little nervous about it because they've heard a lot of stories. So there's a lot of myths that we need to that need to be debunked. So let's talk about the reality of what a HECM mortgage is. So first of all, in the past, they had a lot of negative aspects, and that hence the stories about the negative stories about them. Laws have changed, and there's many of the undesirable aspects have been removed. So one of the myths is that the lender retains the title, and that's not true. The reality is that the borrower retains the title, okay? This loan works like a traditional loan. So the owner or the borrower retains the title to the property, and the loan is secured by the property. Another reality is that the borrower cannot outlive the HECM. What I mean by that is, well, one of the myths is that the borrower can be forced to move out of the home at a certain age. But the borrower can live in the home as long as they desire. So as long as the borrower is occupying that home as their primary residence and keeping up with their taxes and their insurance, the lender will not call the loan due and payable. That is until they reach age 150. So I don't think it's likely that a borrower will outlive this HECM loan. But once they do get to the age 150, they will be the loan will become due and payable. Another reality of the program is that the home goes to the estate or the heirs upon the passing of the last borrower. The myth that we hear is that the children are going to lose their inheritance if the parents get a HECM loan, and that's just not the case. So upon the passing of the last borrower, the home goes to the estate or the heirs. And the heirs have a choice. They can either purchase the home at 95% of the market value, or they can sell it and keep the proceeds from the sale. And like I said before, since this is a non-recourse loan, the estate or the heirs will never owe more than the market value of the home.
Hey, Kathleen, I have a quick question if I can interject.
Yeah.
Right now with the market, like where it's at, I'm sure you have a lot of people either refining or kind of selling or what, you know what I mean? What do you see on average, like when people are wrapping up? I know you guys mainly do the loan creation side, but there's got to be some out there as far as like the selling, when an average reverse mortgage sells, the people, walk away with this amount of money on average. You know what I mean? I'm sure like it's not a zero balance at closing on average. You know what I mean? I'm sure they're walking away with some cash on average. Make sense?
I'm sorry, my internet connection's bad and I only got half of what you said.
Yeah. Kathleen, do you want me to answer that?
Yes, would you, Scott?
Yeah.
Yes.
Yeah. For instance, during the sale on a home, the buyers bring the money into the title company for the purchase. The escrow officer sends a payoff for the payoff demand. They need to know what the payoff is on that reverse mortgage, which is going to be the current balance. And so that has to be paid off so we can get a lien release for the deeds. Mm-hmm. And there's two deeds recorded on a reverse mortgage. One is for the lender that initiated the loan, and then HUD follows a deed right behind that guarantees the seniors that they'll be in their home as long as they want to live in their home. And nothing that the lender can do to get away from that situation. If the lender goes falls into some financial difficulty, then HUD takes over and guarantees the contract. So really safe for the senior. And then with that extra deed on the back of that mortgage for the senior, there's a lot of crooks that'll just bypass that home as far as trying to steal the equity out of the home or sell the home. I know that's a big thing. I hear
that's kind of what I was getting at more is on the tail end. You know, like for the estate or whoever may be selling that, whoever in the end may be selling that home, right? Like for the families, like especially with the market where it's at right now, a lot of people are worried that they're like, there's going to be no home left. You know what I mean? And none on average. And even in a market like today, you're saying that it's 95% of the value. So worst case scenario, they're going to have at least 5% equity no matter what. So at the end of a reverse mortgage, is there any statistic or average number about what's left for the families? You know what I mean? Does that make sense?
I've never seen one, but I can tell you the average length that a senior keeps the reverse is 8.8 years. And that is not enough time to even liquidate all of the equity that's in a home. Because when we loan on these homes, we're only given 50% loan on it. And there's a lot of equity for the family to, when they sell a home, to distribute into the trust or whatever they need to do. So there's a ton of equity, and we always tie the realtors to that HECM purchase. So when that opportunity comes up that the children of the beneficiaries want to sell the home, you guys are the first contact. We get that whole thing involved. You're familiar with the family. You'd be the best position to list that home and get it to market because you've already done a bunch of the homework on that particular home. So that's a guarantee. I wish everybody would make that, but that's been our rule because we're pretty loyal to our realtors. They take care of us and our seniors, and we try and take care of them, of course. So they call and get the figure, Josh, and then that's paid off. And then the family does have, I think Kathleen's going to cover it. They have 12 months to sell that home if we're in a market that's not as exciting as the current one we're in. I don't think they need 12 months.
So number one, people can't outlive their stay, but number two, on average, they don't even remotely come close to touching all that equity, usually.
Yeah, it depends on the market. I think I fixed my internet problem. I can hear you guys now.
Perfect. Awesome. Thank you.
Yeah, it depends on the market at the time, because, real estate's cyclical. But if we're in a decent market, there's usually not an issue. I mean, so, especially with values going up like they have been the last, half dozen years, it's not possible to catch up with the value.
That's awesome.
So,
okay.
That's a good question, though. Let's see. Let's talk about one of the other realities. So there's no required principal and interest payments. That doesn't mean something I hear a lot is that some think that the loan costs are too high because of the upfront mortgage insurance premium. But just like any other FHA product or government product, there is upfront mortgage insurance. And the standard FHA loan has an upfront MIP of 1.75%, and the VA guarantee requires anywhere from 2.25% to 3.3% upfront, and you still have payments with that. For a HECM, the upfront mortgage insurance is 2% of the value of the home, but the big difference is with the HECM or reverse mortgage, there's no required principal and interest payments. So, and while and the interest may be tax deductible upon loan repayment. So, although you're not required to make principal and interest payments, the interest portion may be tax deductible if the borrower should decide to make any payments or upon repayment of the loan. Another reality is that you can use it to pay off the existing mortgage loan or HELOC. So, So the myth I hear is that, well, the borrowers have to own their home free and clear, and they don't. You can actually have an existing loan on your home, and we can use this program to pay off that existing loan, get rid of those payments, and if you decide you want to make payments, you can, but you don't have to. So, and the other myth I hear is that the HECM should be used only as a last resort. And actually, in recent studies, recent studies show, and financial planners agree, that the HECM should be used as a strategic retirement planning tool to extend the retirement horizons for seniors. Many of the seniors obtain a HECM loan to supplement their income or to hedge against long-term care expenses or inflation. So I hope that helps clarify the reality from the myths. So let's talk about borrower options. Housing wealth is where most people hold their wealth these days. And the HECM has become a very powerful tool that you might want to consider. If you're short on income, or if you're unsure that your assets are going to last throughout your retirement or your life or the life of your spouse, then you might want to, then a reverse mortgage can make a big difference. So let's talk about one option is that it's a way to turn off the mortgage payment, making it easier and less stressful to age in place. Or if you have a paid off house that you own free and clear, a HECM can be used to establish a line of credit that's a guarantee for you to access. So maybe you don't need to use it now, but you might need to use it sometime in the future. You can create a stream of income with the HECM or the reverse mortgage. You can use it to supplement your income, either by setting up a lump sum payment or a specific term payment, or you can create a rainy day fund and use it as needed.
Elaine, I got another question. I'm sorry,
Yep.
Forgive me. I got so many questions about these things. Okay, so when you say supplement monthly income on a 200, did I lose you again?
Okay, it's
Scott,
it's dragging again. Go ahead. I can hear you.
Go ahead, Josh. I'm fine too.
Okay, so when you say supplement monthly income, what are you referring to, like, as far as on an average home here, in Phoenix? Let's call it like a $250,000, $300,000 home, right? On as far as I don't know, what is the actual active adult average home price? Is it? I know it's probably a hair below average, right? On average, or is it like 400,000?
It's approaching 400,000. We do a lot of proprietary jumbo loans, and so that throws the figures completely off. But
okay, but when we're talking average active adult supplemental monthly income, what would be an example of that?
Oh, okay. We had a lady come to us from Chase Bank that spent down her annuity and needed to start getting, sad to find $400 a month someplace for her retirement. And we were able to do a reverse mortgage on her, and she gets $402 out of that reverse mortgage until she's 150. Now, I think she was 78. She wanted it, or 81. Now, she wanted this in 9 years, and she could have actually had a retirement income of over $550. If you can either do it for life, like annuity for life payment, or you can do a term annuity, and you can do like 7 years, 10 years, 8 years. You can kind of set that up. And then a reverse mortgage is very unique, so much different than an annuity, because you can change your program anytime you want to. It's not set in concrete. You don't have to move money. It just costs you $20 to set up a different payment plan, or stop your payment plan, or add your payment plan if you're have exhausted your annuity income. So did that help, Josh?
Yeah. So an average active adult who would be looking like, because you're explaining the different options. You can live for free. You can cash out some money. You could get paid monthly. There's lots of different options. So an average person that can take a reverse mortgage out can potentially get $400, $500, $600 a month potentially to live off of. It
depends on the individual.
Okay.
It's a case by case basis. It depends on your age. It depends on your equity. It depends on value of your home. It depends on a lot. I did one last fall for a lady, and she got $1,100 a month.
Sweet.
It just depends.
Yeah. And what's the smallest amount you've seen somebody do it for? About like $80, $100 a month? Like what's the smallest amount it might be worthwhile to do something for?
I think the smallest amount was over $250 a month.
Okay.
They also have an option to draw out anytime they want to draw out of their line of credit to supplement their income. So a lot of people just look at their budget every quarter and take a draw and take it out of the bank.
So cool. Okay. Sorry, keep going.
Okay. So I don't know what's going on with this internet, but where was I? The borrower's options. Yeah. So creating a stream of income. You can also use it to purchase a new or resale home. And in that instance, depending on the age, depending on the interest rates, you're typically looking at doubling your buying power. So if somebody wanted to purchase a $400,000 house and they didn't want to pay cash for it, and they wanted to get the reverse mortgage, if they had like $200,000 in cash, they could purchase that $400,000 house. So it's generally about 50% or so is what they'll need for the down. And then when you understand the sequence of risk and longevity risk and all the other things that could potentially deplete your assets in retirement, having a reserve in the form of a tax-free line of credit guaranteed by your house, it's a pretty good thing to do. So let's talk about the borrower profiles that we see here. So one frequent question I get is, why is the HECM loan used? And there's a full spectrum of HECM customers right now, ranging from those who want a newer home to those who want one for a lifestyle enhancement or for financial planning. And when looking at each of the three types of customers here on the screen, you can see there's one thing they all have in common, and that is they all have no mortgage payments. So you've got your needs-based customer. This may be someone that wants to update their home or replace the roof or the AC unit or even supplement their income. You've got a lifestyle type customer. Maybe they want to live closer to family, or they want to live in a retirement community or some other type of situation like that, or maybe they want to buy a second home with the extra money. Or you've got the planning type profile for a buyer or borrower, and they may want to buy a new home that needs no repairs, or maybe create a hedge against long-term care expenses. Let's look at the needs-based buyer. Here's an example of a needs-based buyer. This is Bill, and Bill is 75 years old, and he still has a mortgage on his current home, which also happens to be in need of repair. His current home is valued at $400,000, and using the HECM loan, he receives roughly 50% of the value, which pays off his existing mortgage, and he uses the remaining balance to make the needed repairs. And he's also able to use some of the funds in his line of credit for emergencies. Additionally, he has no monthly mortgage payments, and so he's only responsible to pay for his taxes and his insurance, and if he has an HOA, he pays his HOA fees. So now Bill spends most of his time on the golf course. That would be a needs-based customer. If you have a lifestyle type customer like Anita, she's 68 years old with a home valued at $500,000. Her passion is traveling, and she's able to live on her Social Security and meager draws from her retirement, but it doesn't allow her to live the lifestyle she desires, and which is a life of travel. All right. So additionally, she wants to live closer to her daughter and her grandchildren. So in Nita's case, using a HECM for purchase, she's able to purchase a new home closer to her daughter and grandchildren. And since she has no monthly mortgage payment, she's able to use her Social Security and retirement income to travel without fear of running out of money. And so just like Bill, she has money left over from the sale of her old home for emergencies. And then the third type of borrower would be someone like that's a planner or planning. So here we have Jane. She's a classic example of using the HECM for financial planning. She's 62 and has a large home with no liens, and it's valued at $600,000. She also is a few years away from retirement, and as she's worked hard for her career, she's now enjoying the benefits of a less stressful hours, right, to accompany her salary. Much large is too large for her, and the taxes are expensive. So Jane has been careful with her money, and she has no danger of running out of money anytime soon. So she decides to downsize to a smaller home that better suits her needs and has cheaper taxes. And over the years, she continues to make payments towards the HECM every month, giving her a line of credit to tap into should she ever need it. And here we go, talking about the payment options again. You have a line of credit, which is a standby line of credit to access when you need the funds. You can establish a line of credit to receive fixed monthly payments for a specified amount of time, or you can establish a line of credit to receive fixed monthly payments for as long as you live in the home. You have term payments, which are, like I said, for a specified time frame, or you have tenure payments. Tenure payments last for as long as you live in the home. It doesn't matter what your equity position is or whatever. As long as you live in the home, you can get those tenure payments forever. And then, or you can do a lump sum, drawing up to 60% of your available funds at the close of escrow in one lump sum, and then the remaining 40% can be drawn after 12 months. Let's talk about purchase options. So using the HECM for purchase, you can purchase a new home with approximately 50% down. Following your down payment and loan closing costs, you'll have no mortgage payments as long as you live in the home. Now, you still have to pay your taxes, your insurance, and your HOA dues, and maintain the home. Let's talk about upsizing. So here's an example of a HECM for purchase that was used to upsize. The homeowner was able to sell their home, their current residence, gaining $200,000 on the sale. So with a 60% principal limit factor, we can contribute $131,000 toward the sales price of a $300,000 home. The borrower can use $169,000 of their $200,000 towards the purchase of a larger, more expensive home, and the remaining $31,000 can be used to supplement the retirement savings. Alternatively, we have a downsizing scenario into a smaller home. The homeowner was able to sell their current residence, again, gaining $200,000 on the sale, but they only need to use $75,000, I wish, towards the purchase of a smaller home, more manageable home. Like if we can find a new home for $100,000, wouldn't that be great? But in that scenario, if they were to purchase a smaller home, they would only have to use $57,000 of that towards the purchase of that smaller home. And the remaining $143,000 can be used to supplement their retirement savings. So now let's talk about the benefits of the HECM for purchase. So as I said before, you have greater home purchasing power. You can move into a home that best suits your wants and your needs. You can relocate. You can retain more life savings, and you can reduce out-of-pocket expenses because you have no required monthly payment. Now, who's eligible for this loan, right? That's the biggest question. So if you're married, at least one of you has to be at least 62 years old. If If the other one is not 62, that's okay. They would be considered a non-borrowing spouse. But at least one borrower has to be 62 or older for this HECM loan. Now, we do have, as Scott mentioned, we do have some other proprietary loans available that you can be 60 years old and even as young as 55 years old. And those work similar to the HECM loan, just a little bit different on the underwriting and whatnot. So, but for the HECM loan, you have to be at least 62 years or older. You have to have approximately 50% or more equity in your home. And you have to be able to pay your taxes and your homeowner's insurance and any HOA fees if applicable. In addition, you need to be able to maintain your home, and it has to be your primary residence. So you have to live in the home as your primary residence. And if for some reason you get sick, or or let's say you have a vacation home, you can live in a vacation home part of the year, but this home has to be your primary home. But if you get sick and let's say you go into a nursing home or something like that, and you're absent for more than 12 months, then the loan needs to be paid off. And the most important thing is, before you can receive a HECM loan, you have to receive counseling from a third-party counselor prior to obtaining the loan. This is an FHA requirement, and we can't do your loan application until you receive that counseling. Eligible properties, pretty much anything: single-family homes, duplexes, triplexes, 2 to 4 plexes, and condos. Now, condos preferably are FHA approved condos, but if they're not an FHA approved condo complex, we can apply for a single unit waiver and to get that unit approved. So one thing to keep in mind with realtors is if you have a client that's looking to use a HECM for purchase to purchase a property and they're looking for a condo, it's not FHA approved, run it by us and we can work on getting a single unit waiver for them to purchase that. Or if they currently live in one and they want to refinance and do a HECM loan to refinance, we can do that. Let's talk about, when is it due? So the loan is due when the last surviving borrower or non-borrowing spouse no longer lives in the home. Okay, so it used to be, and this caused one of those problems with people not liking the HECMs. It used to be that if there was a non-borrowing spouse living in the home, if the borrower died, the non-borrowing spouse would have to vacate. And that's been changed in the last 5 years. So now a non-borrowing spouse is protected and they can remain in the home as long as they like. So when the last surviving borrower or non-borrowing spouse no longer lives in the home, the loan becomes due and payable. So, and if the borrower fails to pay the property taxes, homeowners insurance, or homeowners association dues, and they fail to maintain the property, the bank can call it due and payable. Any questions? Okay. So let's talk about the process. Process is pretty easy, actually. So there's basically 6 steps, and the first step is your education, and which is, basically doing what you're doing right now. Looking for materials to educate yourself on the mortgage process, learning about the advantages and disadvantages of the reverse mortgage. And during this stage, you'll meet with a loan officer, a reverse mortgage specialist, and discuss your available options. And it's during this stage that you should decide whether or not if a reverse mortgage is right for you. Okay. Once you decide that, then the next step is to go to counseling. In the counseling stage is where you will receive, your loan officer will give you a list of counseling agencies, and you select from one of those contacts who you want to use. If you do not receive the HECM counseling, you will not be able to move forward with your loan. So counseling is a must. So once your counseling is complete, let your loan officer know, and then they can move forward with your application process. And during your application stage, your loan officer will ask you for necessary information to complete the application. Did you have a question, Josh?
Yeah. How long does it take to typically schedule and go through the counseling, start to finish?
The counseling is either in person or over the phone. And counseling session itself usually takes about 30 minutes to an hour.
Oh, that's it?
So it's not very long.
Okay.
The problem we're having right now is sometimes there's such a demand that there's a little bit of a delay in getting an appointment. So usually we can get appointments in like the same week, but right now we're seeing like a 2-week delay.
So there's no problem typically in an escrow, 30-day escrow. They could get through it pretty quickly, no problem.
Yeah,
Okay.
No problem. Yeah, and even for a purchase, I've done a couple of HECM for purchases, and they went really smoothly. Once they had their counseling certificate, we were able to get through it like 30 days. I like to ask for 45 days because one thing to be aware of is that on any of these loans, there's a chance that after we get the first appraisal, FHA looks at that appraisal and they randomly decide sometimes to get a second appraisal, and we have no control over that. So if they decide, and that happens about 25% of the time. So if they decide that they want to see a second appraisal, it's kind of a quality control thing. And if they decide they want to see a second appraisal, then we need more time to get that second appraisal done before we get to closing. So that's why I asked for 45-day escrows. But if we don't have that second appraisal, we can definitely get it done in 30 days. So in the application stage, your loan officer will gather your information needed for the application and also let you know what documentation they need for the loan. And then once you sign your loan application, your loan's submitted to processing. And it's during the processing and underwriting stage that the processor will review the application, ensure that you've got the documentation you need. You've already ordered your credit report, so then they ordered the appraisal at that point and open title and gather any further documentation that the loan officer might have missed out on. And like I said, once the appraisal's finished, your file is submitted to underwriting. If you don't require a second appraisal, then it goes through underwriting pretty fast, like 48 hours, 72 hours. And then once the conditions are met, you're clear to close. So when you get to the closing stage, your loan officer will contact you to schedule the final closing. And most of the closings are done remotely with a mobile notary. So a lot of times the mobile notary will come to their house and they don't have to go into the office. So that's kind of convenient. Or they can meet us at our office and whatever's convenient for the borrower. So once you sign your documents, you have 3 days to decide to cancel the loan, because on a refinance, on the purchase, you don't have that option. But on a refinance, you have 3 days to decide to cancel the loan. And when that waiting period expires, the loan funds and the monies you requested are dispersed. And so it closes. So, and then the final stage is the servicing. So approximately 45 days after closing, you'll receive a welcome package from the loan servicing team. And that package includes instructions on receiving draws on your line of credit, and if you've chosen that option. It can also contains important information regarding the servicing of your loan. So you'll want to hang on to that package. You may need to access it in the future.
Celine, this is Tammy. What is the typical credit score that the borrower will need? Because generally, if they're looking into getting a reverse mortgage, they probably have fallen behind a little bit before that became the option they chose.
Actually, that's a really good question. And unlike traditional loans, the HECM loan and reverse mortgage industry is not based on FICO. So we don't have a minimum FICO score. One of the things, so if they've got some slow pays or some credit issues and stuff, that's usually stuff that needs to be explained, but it's not necessarily an instant turn down. Especially, because sometimes you have like a medical issue that came up and you got, behind on stuff and or other things have happened. So there's no minimum FICO score. If they've got, I have seen like instances where they've got some really slow pays on some credit and whatnot, and some issues there. The one thing that the underwriter may require is that they do a LISA, which is an acronym for life expectancy set aside. So, and what that is it's not an escrow account, but it kind of works like an escrow account. So what they'll do is they'll take some of their equity from their line of credit and set it aside to pay their taxes and their insurance. So the mortgage company knows that maybe they appear that they're not really the optimum credit person. They may end up getting into trouble not paying their taxes and insurance. We don't want to foreclose on them. So if they've got the money in there, maybe they'll be required to do a LISA. It's still their money. It just gets set aside. And so the servicing company pays their taxes and their insurance. So they don't run the risk of falling behind on their taxes and insurance and getting into foreclosure situation. And it's a case-by-case basis. So, I would say, encourage them to talk to a loan officer before you say, oh, well, this is never going to happen, because you'll be amazed. And that's why it's the only loan made specifically for people in retirement, because people in retirement don't fit the traditional guidelines. So does that answer your question?
It does. Thank you. I had heard that you pull a credit report. So when I heard that, I thought, well, maybe there's a, set limit.
No, we have to pull their credit because we have to make sure that they have enough income to support their payments of their taxes and their insurance, and a residual amount left over, kind of like to live on. And so if they have a lot of debt, we have to make sure that it covers their taxes, their insurance, and whatever other monthly revolving accounts or loans they have outstanding, and still have a residual amount left over to live on.
Kat?
And it's pretty minimum. I mean, it's pretty easy to qualify for. So
Kat, this is Linda Walton.
Uh-huh.
I have some questions also.
Yes, Linda.
I'm with Ward Realty, and
Hello.
I work in the senior communities. Probably almost 100% of my sales are in senior communities. My question is, so someone decides that this is a really good product and they want to move forward. They have 50% equity and everything falls into place. And then a year or so later, they decide they've lost a spouse and want to sell. Now, so other than like in a normal situation, when you get a loan, you have all the upfront fees. And I understand that the borrower retains the title. It's about 2% of the value of the home is what you have to pay for the FHA loan. So you're paid for those upfront. Now, the reverse mortgage is paying the house payments. You're keeping up with the now all of a sudden you're just in this a year or two. I mean, it's at today's prevailing interest rate. I'm
sorry. I got you up until you're keeping. My internet's acting up again. Can you repeat that question, Linda?
So my question is that it works under today's prevailing interest rates. And so if they choose to pay it off, it's just the balance plus whatever they didn't pay. In other words, if you made a year's worth of payments at a certain percentage, is there also a payoff penalty?
There's no prepayment penalty on these.
So if they decided they wanted it they thought up front they were going to want it for their lifetime, but things, as we know, change. And
Right.
they decide they're going to move, they need to move to be back with their kids, and they feel like, oh my gosh, I had $200,000 equity. Now I've only, I went into this HELOC thing, or what it was, like, I'm sorry, into the reverse mortgage, and they still can sell, correct? I mean, they still have
Absolutely.
to sell, and they would still be able to, take that remaining equity as their own.
Absolutely. It would be just like a traditional sale, they pay off the loan balance plus any accrued payments. The loan balance will include any accrued interest, and they pay that off and they move on when they sell. So it's real similar to a traditional sale.
So just as the accrued interest, so when you make the payments, you're paying, the reverse mortgage is paying principal and interest. Is that correct or no?
Well, if they decide, if the borrower decides to make a payment, they can make any kind of payment they want to make.
I understand, but they don't want payments. They got the loan because they wanted to be away from payments. Now they've changed their whole focus of what they want to do due to health issues or needing to get closer to family or whatever. Is there any additional interest that they're paying? In other words, is the interest accruing differently? I just want to make sure I understand.
So the interest is accruing and it's being added to the balance of the loan.
Okay, so there's no, like in a normal mortgage, every month the principal is a little less. That's, of course, that's not the, in other words, every month the principal of the mortgage is a little more then. Is that correct?
Right.
Oh, I got you. Okay. All right. Thank you very much.
If I'm following you correctly, Linda, so you're thinking, like, hypothetically, like, let's say that they wanted to purchase a home and have no monthly payments whatsoever. And so that was their first option. Boom. And then about a year later, let's say a spouse passes away and they want to switch from a living mortgage free to now I potentially want to start taking a draw of $300 or $400 a month. What would be their options at that point in time?
No,
She's wanting to sell.
they want to sell their house and move away.
Sell. Okay. Yeah. In that case, hopefully not much penalties at all.
Yeah. So the interest that would accrue in a year, depending on the loan balance, would depend on the loan balance and the interest rate, and so right now you're looking at about, a 2% interest rate, so, or 2.5, 2, depending on which type of loan they got. So it wouldn't be that much that would have increased by.
Are your interest rates that of FHA then? Would they be, since it's an FHA loan, it's an FHA interest rate, or is it a conventional rate? What kind of an interest rate are we talking about?
It's an FHA product, but it's not FHA loan rate.
I mean, you're quoting 2%, but right now conventional is over 3%. It's between 3 and 3.25, more like a quarter on a 30-year.
So if they were to get a line of credit, a home equity line of credit, that would be an adjustable rate loan, and with a 5% lifetime cap. And today we're looking at like 2.2% starting rate.
So these are adjustable rate loans. These are not.
These can get fixed also, but if you want the line of credit, they're adjustable.
Okay, but if they just want the HECM loan, where they're just the payment, they're well enough off. They're just concerned about the future. They just don't want house payments per se. They've got adequate income to handle everything else, and they don't want to draw. Is that a fixed rate product then?
Yes.
Thank you.
I love this. I'm finally learning too. I was like, I think I'm trying to answer these questions in the back of my head, and I finally got one right. That's awesome.
Yeah.
So Kathleen, you say the no mortgage only payment is a fixed rate. What rate does that mirror? Is that current conventionals? Is that, I think it was questioning, is that an FHA interest rate? Like,
So
when it gets fixed, what is that?
Yeah. So the fixed rate today, what are we looking at, Scott? About 3.5?
Yeah, 3.53 today. And I think you can buy it down to 3.38. You have to pay discount to buy it down. So it's relatively pretty much the FHA rates that mirror the traditional loans, or
On the
FHA.
fixed.
Yeah, FHA standard loans. So it is.
Okay, so let's consider the possibilities. So with the HECM loan, you have more retirement experts are recommending the HECMs. You've got lifestyle sustainability, you've got financial security, financial planning, peace of mind, age in place, increased purchasing power. And as a real estate agent, because awareness of the HECM for purchase is still relatively low among home buyers and real estate agents, there's a good opportunity to gain competitive edge by learning how to educate your clients about the financing options here. So when a buyer uses a HECM for purchase, they have more availability of funds to afford the home they really want and the location they desire. And they're able to maintain greater financial control. So this can bring a new opportunity for you to sell more homes to an expanding market of home buyers. Older Americans are buying homes. In fact, according to NAR, about 30% of all home buyers are age 60 and older. And most of them finance the purchase of their home. So, and these are NAR, this is from NAR, I think from 2020, 2019.
So Kat, I also, if I may just jump in. So do you have any kind of brochure that explains your product? Because and like I said, I sell a lot of homes in the retirement communities, and I would love to be able to talk to my clients about this product. Knowledgeable.
I would love to just sit down with you and have a cup of coffee for 30 minutes. I can give you some brochures you can hand out, and I can also email you some so you have it on hand. And, we can get more clarity on what your questions might be. And if you have any clients, feel free to give them one of those brochures and have them talk to us. And we'll be happy to explain to them, figure out what their situation is and see if it's a good fit for them.
With your permission too, I'm going to send this video out. I'm going to do a little bit of editing and blah, 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 but I'm going to send this video out to, you, Linda, and you, Tammy, because you attended the class. And I think, Kathleen and Scott, you said that they can go ahead and send this, to their clients too, if they want. So that way they can get some education as well, right?
I think so. I know I can send it to you guys. I know you guys can have it. I don't know if I can authorize you guys to send it to anybody else.
Okay.
Yeah, Kathleen,
check.
quick question. So I'm actually transporting for 3 team members who are real estate agents here. And so I would like to be able to get them the brochures. So how do I sign up? I mean, I understand, Josh, you're going to send this to me, and that's amazing. I need it. I've tried to take a lot of notes, but the PowerPoint is definitely going to help. But I've got these 3 agents that, of course, were out selling homes and already had schedules and couldn't get here. And so I'm attending on their behalf. But I would like to be able to show this presentation and give them the pamphlets, because, again, we are here working in Surprise, Sun City Grand. Like a lot of the clients are 62 plus. So how do I get that? Do I just shoot you an email and ask you to send it to me?
Sure.
Okay.
Sure. Yeah.
Perfect.
Be happy to work with you guys and help you any way we can. I mean, it really is. It's a underutilized program. That's like Josh says. I mean, it's amazing. It always amazes me, even people that are financially secure, that come back to me later and go, wow, we are so grateful for you guys helping us get this program, because it's mentally life changing. It's a relief.
To be quite blunt, at the age of 62, or the right age, why would you ever pay cash for a home? All things being equal, why would you? You could either
the one thing you want to do
home and save so much cash, or you could buy that much more home and still not have a payment. Why would you just not utilize that extra power? Why? It doesn't make sense to me,
Well, there's the big reason is, and I've heard this 90% of the time, they want to make sure their kids have there's a lot of equity left for the children when they sell the house. So they want to give them a house free and clear. And being in the Sun City area and all the fire sales I've seen after the parents pass away, I don't know where that money's going, but it's going awful fast, and the discount on the houses in a different market are pretty big. So I don't know. I think that parents need to plan on, living independently as long as they can and not worry about their children growing up. I'm sorry. There's some of them are just still struggling with the growth problem.
Yeah. A friend of mine, she recommended that her mom get it, and her mom got the reverse mortgage, and it allowed her to that extra money that she wanted to travel and to have fun and to do things that she wanted to do. And both of her brothers were so angry with her that that her mother was spending their retirement. And I just think it's really funny how kids see their parents' hard work and savings and as theirs.
Yeah.
like you've got your whole life to build that for yourself. I mean, but also in addition to that, there's a lot of studies that now show that it's really wise to get a reverse mortgage early on in your career and your retirement, because you can use it as a tool in your retirement to extend your retirement horizons. And the studies show that people that do use the reverse mortgage strategically end up leaving a lot more assets and investments to their heirs than had they not used it. And a lot of people think that they want to leave the home to the kids, and in reality, the first thing the kids do is call a realtor to sell it, because they don't want the home, And so if you can leave them a legacy to them in another way, and this helps you stay in your home and enjoy it, it's a really great thing to have. It's a really great option to have.
Yeah, well, and if it keeps up, it's a hedge against inflation too, kind of, because if you're at a 3.5% interest rate, I mean, what has real estate done over the last 5-6 years? That alone was enough equity to buy you how much time? Theoretically, and the likelihood of their worst case scenario, let's say the kids, oh my gosh, you sold our future. No, the likelihood of people selling the home and still having money at the sale is very likely. And as far as I can see, the market will change eventually, but I don't think we're going to see a 40% plummet by any stretch of the imagination. Arizona is just too strong. It's going to soften, but I highly doubt we're going to see a plummet. And that would be the worst case scenario. But again, it's cyclical. Give it time. It'll come back. You know what I mean? So
yeah,
I see, no matter which way you slice it, I see huge benefit here. And I'm trying to convince my parents. And I'm an only child. So there you go. I'm trying to convince my parents to do this.
I love it. That's awesome. Yeah.
So, all right. Well, is there anything else? I know we kind of cut you off a little bit here or whatever, but keep going.
Let's see.
Run.
Oh, so Scott and I put together a couple of graphs just to give you a visual of how this affects your equity if you use a reverse mortgage in a couple of different scenarios. Now, these are just graphs to show you an illustration of how this works. These numbers are not exact. They don't consider all the costs involved whenever. It's just oversimplified illustration to give you a visual understanding of how the program can benefit you. So in this first graph, they wanted to use the reverse mortgage to eliminate their mortgage payments. So, and the question in their mind is, is that payment better used somewhere else? You know, if you're making $1,000 month mortgage payment, it may not be hurting you to make that payment, but can it be better used somewhere else? Can you invest that in the stock market or in your IRA or on your Roth? Instead of making the mortgage payment, you invest it somewhere else and maybe get a better return on it or better benefit out of it. So in this scenario, we have a borrower age 62 years of age, and they have a home valued at $500,000 with a mortgage balance of $150,000 and mortgage payments of $1,000 a month. So they obtain a HECM ARM, adjustable rate mortgage, with the line of credit to pay off their existing mortgage and eliminate their mortgage payments. And so in this illustration, you can see that the black line here is the home value, and we're assuming a 4% appreciation per year, which is the national average. I mean, the average over like a 50-year period, anywhere from 3 to 5% appreciation. So we're assuming a 4% appreciation in the home value. And so this black line, you see it going up over the next 30 years. The blue line is their net equity and you see that going up over the next 30 years. The red line is their loan balance. It's their ending loan balance at the end of each year. And the blue line is their the green line, at the very bottom, is their line of credit. So if you look at this, assuming that they don't, draw a bunch of money out and whatever, you can see that their line of credit grew from like $111,000 to start with to, at the end of 20 years, $185,000. And that's not making any payments or anything on it. It's just naturally going to grow at whatever their interest rate is. So to answer, I'm not sure if it was Linda's question or somebody had asked the question about the payments. So even if they're not making payments and they started off with a line of credit, it still continues to grow at whatever their note rate is. So even though their loan balance is growing, their line of credit is growing also.
So Kat, if you start off with a loan that is just a HECM without any cash reserve option, my understanding is it's a lower interest rate, and that can't be changed down the road. If you decide you want to tap into that equity, you would just have to pay off the loan. Is that correct? I mean, you wouldn't be able to get any equity. If you started off without wanting to get in this situation where the interest rate is going to continue to go up, so you wanted to lock in a lower interest rate, then whatever equity is in your home, you can't tap. Is that correct?
So I think if I'm understanding your question, like for instance, if you started off with a fixed rate loan and you didn't want that interest rate to go up, you wanted it to stay the same. Is that what you're asking?
Yes.
Then yes, you do not have that line of credit that grows. So whatever you have when you start off at that time, that you have to take it then, and that's the only time you can take it.
Okay, so if you have, say you have 60% equity in your home, and you only have to have 50% equity for the HECM, right? So can you take that additional 10% in cash at the beginning then?
Yeah.
Perfect. Okay, thank you.
Mm-hmm. So I didn't know, Scott, if you wanted to add anything to this or.
Well, yeah, Linda, there's the cash that if they leave it in the line of credit, let's say it's 20,000 or 30,000. So that'll grow every month. It'll get bigger every month by the current interest rate plus 0.5%. So if we get some inflationary pressure which drives the adjustable rate mortgage rates up, the line of credit growth also goes up too. And so this vehicle is the only thing I've ever seen with an inflation protector. So it protects the dollars in the line of credit. So you can use those dollars, will be the same purchase power today, hopefully, as they are, 5 years from now. So it'll increase.
Scott, though, if you are taking an adjustable rate mortgage on, say, a $200,000 balance, I don't know whether you're taking on the full price of the house. Is that what it is? I guess I'm lost there.
No, you get a certain percentage of the value.
Yeah, if you have a $400,000 home and you have, say, $225,000 equity, right? And so you're thinking about taking the HECM loan. All right, so is the HECM loan that interest rate on the full $400,000, or is it on the $225,000?
It's on the money that you've taken out, only on the balance that you've taken out. So if you took the whole $225,000, the interest would be on $225,000. But if you only access $50,000, then it'd just be on the $50,000, compounded monthly. So every month it'll go up a little bit. For instance, I looked at one the other day. The balance was $330,000, and the accrued interest on it was under $500 per month. Now that's a lot lower than a payment on a $300,000 loan. So the interest just does not equate right now. It's much easier to get a reverse mortgage at 2% than a conventional at 3.5%, because on a conventional, of course, you're paying principal and interest, and then on a reverse, you're living in the principal, so you only add the interest to the balance. That's the big difference. There's no principal payment out of your pocket. You own the home. It's yours. You just have to pay off the interest when it's all settled and sold. I hope that helped you a little bit.
Actually, it confused me more, but that's okay. That's okay, Scott. I'll contact you one-on-one and not take your time.
That's
Okay.
funny.
Yeah.
I was thinking that was a great explanation.
Yeah. Well, what's so cool about it, and to kind of wrap our head around it. So you said the person literally borrowed $325,000. So that's the size of their loan, and their payment and the balance, quote unquote, only went up by less than $500.
Correct.
Okay.
Yeah, that's correct. Yeah.
And that's about that. What is that? Probably 2-3 times what a lot of people borrow. So you're talking like an average person, the balance is going up like it's not a lot. It's not a lot at all. But even worst case scenario, let's fast forward, let's say they live 100 years. Okay. And then they go to sell their home. They've maxed out everything. They still get the 5% discount when they sell their home.
Oh yeah, they do. But you've got to look at the appreciated value too, Josh.
Yeah.
And if they're 150 and they're going to sell their home, that home's going to be millions of dollars for the sale, and the balance will never make it to $1 million. Never make it that high. It just won't. It doesn't have the capability of doing that.
So Linda, it's confusing until you actually sit down and go through the proposal, the process on one particular situation.
I understand. Thanks, Kat. I appreciate it. I'm very interested in this product.
Yeah, it's simple, but it's because it's backwards, it kind of makes your head go in circles until you actually see it and you actually have done it or walked through it. You don't have to actually do one, but walked through it each stage of it on a specific scenario. It's a lot easier to understand, and we'd be happy to go over that with you guys anytime. So,
Kathleen, I just have a couple more questions. I'm noticing no closing costs.
Yeah, like I said, this does not consider any of this is oversimplified. This is not a real scenario. I'm just doing this for visual purposes to show you visually the effects of your net equity and the loan amount in different scenarios.
Okay,
So-
and then the other question that I had was, in this day and age, in this market, like, you know, you don't you don't get a chance to not end up in a bidding war on buying a home anymore. And now you're asking that we need 45 days and I got to go counseling and all. Can we get buyers through the process, even though they don't have a home yet, so that when they go out looking, they've knocked out as much of this stuff that needs to be required to be done?
Yeah, I
prior?
hear you. Yeah, well, we can take it so far. So what I would recommend, if you have a buyer that's considering this, before they start the home process of looking for homes, to have a meet with a loan officer, go through the initial proposal of it so they understand the program, what they're getting into. Get their counseling, because that counseling certificate, I forgot to mention, is good for 6 months. So go through and get their counseling before they even start the home search, and then have their documentation ready. Like most people, to qualify for this loan, they use their Social Security income. So we just need documentation on their Social Security income, and and if they've got a more complicated case, well, if they have rentals and stuff, we'll need lease agreements and stuff. But if they need to use that income. And so we can have all that paperwork together and ready to go. We still have to go through the actual process of the, pulling credit and the loan application and the appraisal. The appraisal is the bigger factor there. So, sometimes the appraisals are getting done in 2 or 3 weeks, and, sometimes they're taking a little longer. Most of them don't take that long, especially if they're in a suburban area or a city area. If they're out in the rural area, it's sometimes harder to find an appraiser, so that's why it takes longer. But most of the time, we can get an appraisal ordered in a couple of days, and appraiser pick it up and run with it. So
she kind of brought up a really good point there, really fast. So let's say somebody decides that they're going to do a HECM. Okay, so let's make it just cut and dry. They're going to use it to purchase. All right, they make the decision today, which is wonderful. So they go ahead and talk to you. They can go ahead and get their counseling taken care of. They can lay all the foundation. You get them all the financials, and then it's good for 6 months. Okay,
the certificate is.
Yeah. So let's say it's good for 6 months. At that point in time, if we're going to be presenting an offer on behalf of one of our clients, are we basically, for lack of a better term, we're stronger than a conventional loan. We're not quite as good as cash. You know what I mean?
Yeah.
Like, what do you provide us to give us that edge? Because if they're going to need a 45-day close, you know what I mean? That's kind of crappy. It's not going to give us the edge. So what can we do to kind of spice up our offer in this case to make it?
Yeah. We can give you a pre-qual letter. We can't give you a pre-approval letter, if that's what you're asking.
Okay, but like if we're going to talk to like the listing agent, I guarantee the listing agent is not going to know what we present them as far as a HECM, because chances are they haven't encountered one before. You know what I mean?
Right.
So
yeah.
If we're going to call our agent, we can basically like say, hey, listing agent, my guy, they're doing a reverse mortgage. It's basically, for lack of a better term, it's cash. That's what it is, and they're good to go. What would you tell a listing agent to get them to accept your offer?
Well, I just did one earlier this year. I was representing a buyer, and he was using a HECM for purchase, and I was the buying agent, the buyer's agent, and so I explained to her, the listing agent, that it was a buyer that had really strong financials. He was well qualified. We had a pre-qual. Put her in contact with the loan officer so she could talk to the loan officer and feel confident that he was definitely well qualified, and that he was putting 50% down. So the chances of having an issue on the appraisal was slim to none.
There we go. Okay.
Right. And it was going to be his home for the rest of his life. This was his, he's going to he decided he wanted, he's probably 72. He's like, this is it. This is my home. This is the one I want. And, and I saw, and basically just explained to her, this isn't an investor. This
Like
is
the
somebody that
heartstrings.
wants this home. Yeah. And they appreciated that. And we were the highest offer on top of that. So that helped. We didn't go crazy over though. We didn't go, actually we ended up negotiating better than list price. But we were able to find a seller that appreciated having an owner occupant on top of one that was putting 50% down.
Okay. And so last question I have is, as far as the closing cost then, whereas a typical conventional mortgage, 1%, approximately whatever, do they need to anticipate bringing like 3 to 5% just in closing costs to closing, or does that get drawn into the mortgage usually? How does that typically work?
Yeah,
Cash equity.
it all comes up to about 3% or so, depending on the price range we're talking about. And that is taken into account as part of their down payment ultimately, really, because I mean it is drawn into the loan amount, but they've got a maximum that they can get. So I would just say they would need to have about 53% of the purchase price available, and that should cover everything. But I would go over that with them in more detail on a case-by-case basis.
Okay.
So, because they're going to have title fees like you would. Our closing costs are pretty low. Typically on our side, you're looking about was about $1,500, Scott. Our closing costs on you've got title costs and you've got our costs.
Yeah, on a purchase, I would say 2,000, because title fees on a purchase are they're not alt fees, they're regular fees. And then the seller in this market, the seller's been paying the the owner's policy, and the HUD has allowed the seller to pay for the warranty, which has been nice. They haven't done it for years, but they decided that that's probably a good thing. So I'm glad they changed that a couple of years ago.
Yeah.
So the rest of the expense is going to be the buyer's expense. So, and your sellers are probably used to paying owner's policies, I'm sure. So.
Yeah, half the escrow fee and owner's policies what the seller can pay.
Yeah.
So, and the homeowner's home warranty, excuse me.
Yeah, I definitely do a home warranty. You don't want to call at 3 a.m. from your buyer saying, "Hey, this house, you sold me one with a bad water heater."
Yeah.
So you just give them the warranty company phone number, and they'll take care of that.
Perfect. All right. Thank you so much, guys. Anything else before we start wrapping up?
No. There's another one here that shows if they decide to make annual withdrawals. You look at the chart here, and you can see, like this. In this instance, these people were 70, and they decided they wanted like $40,000 at closing. They owned their home free and clear, so they got a line of credit. They took $40,000 at closing, and they decided over the next 5 years they wanted to spend $10,000 a year on traveling, whatever. So they took the money out of their house instead of out of their investments. And then the next 5 years they spent $5,000 a year. So you can see in this chart that the green line is their line of credit, the red line at the bottom is their loan balance. So with their withdrawals every year, you can see the loan balance is growing a little bit faster, and the line of credit is going down because they are taking money out of their equity. Still see the blue line is their net equity is still substantially higher than the balance, even after 25 years. So I know a lot of people are worried about the equity getting eaten quickly, and if they make draws, it does affect it, but not as drastically as you think.
That's a prime example of your $400 to $500 a month bracket. That's perfect. Yeah.
Yeah. And then this last one is somebody used it as a hedge against the market. So in this scenario, the borrower was T2. They used the HECM to eliminate their mortgage payment. But because they're young and they're still working, they decided to take that $1,000 mortgage payment and they continue to they use that $1,000 as a payment on their loan. And so required to make that payment, but they decided $1,000 payment until they reach full retirement age 70. So the 8 years they're making that mortgage payment, and you can see the loan balance in the red goes down over those first 8 years, and the line of credit grows in those first 8 years. So in this scenario, after 20 years, their line of credit has grown to $330,000. Now they can those payments after the 8th year. They're not making payments after that, but their line of credit is still growing at the note rate. So in 20 years, it's gone from $111,000 to $330,000. And their loan balance was going down those first 8 years, and then after it's only $105,000. Yet their home value is to go up, and their net equity is nearly $1 million after 20 years. So
people really need to take advantage of these interest rates that are going on currently. Is pretty much what it boils down to.
Yeah, that's really it in a nutshell.
Yeah. Jump in early.
Jump in now before it gets crazier.
Kathleen,
That's
one
about
last
it, guys.
question.
Oh, do you have any other questions or anything?
I do. I have one last question for you. You had mentioned that you do have other programs starting for people that are 55. And we're not going into that today. I get that. Do we just, if we have some people that are interested in that, do we just have them contact you? Do we have them contact Scott? Who do we have if they're under 62 but over 55?
Both Scott and I can help you.
Okay, thank you.
Yeah.
Yeah, we also have a real strong forward mortgage department, traditional loans, and Jack is one of our loan officers, and he runs that, and we're closing them quicker 30 days now. Oh, there he is.
There's Jack.
Yeah, Jack's come on board, and the last one I think we closed was just a little over 2 weeks, wasn't it? Yeah, it was about, and a lot of work with Open's done a lot of work on their traditional loans. In fact, we're over 1.5 billion, and so we Fannie Mae and Freddie Mac and Ginnie Mae has just welcomed us aboard, and we'll be servicing reverses next year. So that'll be really nice. Seniors will be able to look up their reverse mortgage stuff online, and looking forward to that. I'm just amazed at our forward mortgage business, how fast it is, and we'll be a lot more competitive next month because Fannie and Freddie, we're going to sell directly to them. So we'll have some really good pricing for your clients.
Yeah, I having done mortgages in the past and doing them again now and working at Open, I will tell you, I'm really impressed with their support staff that they have and the processes that they have. Very conscientious, making sure that get the work done timely and quickly. And like when I have been a loan officer on the loan officer side of doing a HECM for purchase a few times.
Thank you, Linda.
And the process was seamless. It was wonderful. I was very nervous, but it went well. It went really well, and we were able to close them both in 30 days. So I'm really pleased with with Open and their processes.
All right. Thank you so much, Scott and Kathleen. Last but not least, I have to toot our horn one last time. Breakthrough. We are a great brokerage. I'm sure, you guys are probably happy where you're at, but if you're ever looking for options, please give us a consideration. But we have property management, and seriously, like our property management, that's when I got started 13 years ago, I knew I was going to start a property management company, and that's been our main focus from the beginning. Last year, it's what provided my parents their retirement, and that was the goal. And now it's going to take care of me and my family. and we take wonderful care of people. And then because we got burned so many times in property management, that's why I started my handyman company. We specialize with realtors, we specialize with property management companies. We'll take care of bins of repairs, you name it. So
That's right on.
even if it's
That's
not
awesome.
perfect, we could still totally help you out on numerous fronts. So
Yeah.
everyone,
Well, just
Josh, gonna need your contact information, please.
absolutely.
is my screen still on?
Yes, ma'am.
It is.
So yeah, so that's our contact info right there. And I would to get your guys' contact information too, so we can send you our brochures that we have and maybe meet with you guys and do a one-on-one. And just so you know, I mean, I am still a realtor, but I don't pursue it. I only work with past clients of mine, and try not to work with too many people. I prefer doing the mortgages.
Perfect.
So,
All right. Yeah.
But,
and Sarah will send everybody. Sarah is our office manager. She'll make sure that everybody has everybody's information. So,
Yes, I
that
will.
sounds awesome.
I put mine in
Hey
the
guys,
chat.
anytime you guys want us to do one of these, we're open to it. We love doing it.
awesome.
So,
Thank you.
All right. Thank you,
all right,
everyone.
Thank you guys.
Have a great day.
Have a good.
Bye.
Oh, oh.